risk in stock prices. Basically, a concept that I think is first order for us to understand why asset prices move around as much as they do. This is actually a summary of 3 papers in 15 minutes, isn't it? But hopefully it'll be a seamless transition for you guys. So, go. Okay. All right. Okay, so a fundamental question in finance is this: why do prices move much more than fundamentals? Okay, and it dates back to last year's Nobel Prize winner, Bob Shiller. This is a graph from his paper. The econometrics here have been updated, but the conclusion still stands, which is that if you find sort of a fundamental price, this is S&P 500 from 1870 for the study 1980, and if you find the fundamental price as future dividends on the market, discounted at some constant discount rates, right? Sort of present value formula, but with a constant discount rate, then the prices look very stable. Whereas the actual market prices are moving around a ton here. This sort of the average here is 150 down to 75 up to 225. And so there's these large fluctuations in valuation levels that we observe in market. So in sum, the prices are much more volatile than fundamentals. And so something is going on. And Shiller, being of the persuasion he was, would say it's mispricing. At some points in time, just investors get very excited about stock prices. They get overly excited about future dividends, and prices are too high, and sometimes they're pessimistic. Right? That doesn't need to be the story. It could be time-varying risk premiums. So it could be that when prices are really high, it's just that discount rates are really low. Or when prices are very low, it's just discount rates are really high. So this is sort of some ways you have to think about this. Now the way we're thinking about it is somewhat different. It's neither really mispricing or necessarily time duration risk premiums. So I'm going to think about model risk and what model risk does to expectations. And Shiller's main point was that if you're a rational person, your best guess is less noisy than a realization. But that intuition relies on the fact that you know the model of the world. So I'll go through that in a second. But a typical asset pricing model assumes exactly that. You know the model of the world. So you know, for instance, what the growth rate of dividends is going to be on average. Of course, sometimes they're high, sometimes they're low. That's fine. On average, you know what the long run is going to be. If you do not know the long run, however, things change a bit. And so in this setting, it's got to be that the variation equity premium is due to discount rates. So I'm going to argue that this full information assumption is extreme. In fact, whenever I talk to MBAs, practitioners, anyone else, and they say, well, we assume that the agents know everything about the economy, they all say, that's crazy, right? And it is at some level crazy. And I can hope, you can cross your fingers and hope that this sort of aggregates out when you look at aggregate prices. But I would argue that no, we do not know the true model of the world. Instead, what we're forced to do is the best we can, which is to form beliefs based on some available models. And we estimate these models, and when new data comes along, we might revise our model. I say, oh, that model I used to have wasn't that great. I'm going to have to re-estimate the model, maybe a new specification, maybe just new parameters. So I'm going to do this sort of a very intuitive level. I'm going to start out with the question, what's a model? And I'm going to think about cash flow expectations. So think about dividends or project cash flows. So everything in finance can be reduced, and at least in asset pricing can be reduced to present value calculations. So that's what we're going to do. Present value is future expected dividends divided by some discount rate. And so when you have done project valuations in MBA classes, you all were trying really, often you're told to hold the discount rate constant, yet the valuations varied a lot because you had different dividend expectations, right, for your projects. And when you're forming those expectations, you are using a model. Either you're doing it intuitively and saying, I feel that Google is going to grow a lot. Or you have a model where you put some numbers down. I'm not saying one is better than the other, but you have something in the back of your mind that allows you to form those expectations. So let me give you an example, and I'm going to do an example of an explicit model. And it's a very simple model. I'm just going to say that market dividends are mean reverting in growth rates. Sometimes the growth rate is high, sometimes it's low, but it's sort of mean reverts, so it's sort of a standard type model. You could write it in this type of fashion, or in logs in this kind if you want. So here, the G here is the dividend growth rate, right? And And it follows what we call a mean reverting process. And so it's just if the dividend growth, GT, was high in the past period, then this rho is typically positive, this parameter here, then future dividend growth is typically a bit higher than average. So in expansion, dividend growth is high, and then it sort of reverts back down. That's the idea. Now you look at that model. That's a model. Okay? You look at that model, it has 3 parameters. It has the average growth rate, G bar, 2% per year, maybe real. It's got some autocorrelated parameter here governing how persistent shocks are. And it's got sort of the volatility of shocks. Those 3 parameters are inputs. So first you decide on a model, and then you have to decide on these inputs. Now how do you obtain these? Typically by introspection and estimation, right? You might use some theory, and you might estimate this. Importantly, as time passes, more data arrive. You re-estimate your model. You get new parameters. You might even choose to add a different specification of this altogether. You might say, hey, there's no crisis state here. It was just a financial crisis. Maybe I should think about putting that in. Okay? So that's what we're going to consider. And the main intuition comes from the following. Model risk have a big kick for valuation because when you change a parameter in your model, this is what you're using to form future expectations. You're saying, okay, I'm going to expect the future dividend growth. I'm going to use that model. And for those of you who know how to do it, you see it immediately. And for those of you who don't know, I'm not going to explain it. That's a little bit of piece of math that gives you future expectations. You change the parameters, you change the expectation forever in the model. So I'm going to give you a simple example that everyone can follow. Consider the Gordon growth model, right? That is a model. It's very simple. The dividend growth is now just constant. It's G. And there's a constant discount rate, R. Your current model is a discount rate is 9%. Comes from some preferences, something that maybe you know something more about. And that the growth rate is, say, 5%. If that's the case, the price-dividend ratio is 25. Okay? That's your model. It's constant. Doesn't mean that dividends are constant. That means expected dividends are constant. What happens if more data arrives and you say, you know what, I don't think the growth rate of dividend is 5% anymore. I'm going to revise my model. If you observe low growth and you re-estimate the long-run dividend growth rate, maybe get a new estimate where it's 4%. What happens to the valuation level? Well, it drops 20% to 20, from 25 to 20. What if you observe high growth and revise it up to 6%? Now the price-dividend ratio goes up 30% to 33.33. And so the question is, of course, why did a 1% move in growth expectations have such a large price impact? Because it lasts forever, okay? You just say, I don't know what the long-run growth rate is. If I update what that thing is, it's going to affect my expectations forever. So it's what we call a permanent effect. So when you're looking at claims on assets that are long-lived, you update your expectation just a little bit. I just updated the expectation here, plus minus 1% in growth space. But in valuations, that created a big impact, okay? This is an example, but this same intuition comes from Bayes' rule, which is a way to show you how should you optimally update, okay? And so it's not just, it is actually a representative example of how you should update models. If you don't know G, that's the key thing. The standard models say you do know G, but you don't. And so if you don't, Bayes' rule tells you how you ought to update, and this is what's going to happen. So that's what we're doing. But of course, this was a very simple model, so we're going to obfuscate things and make them very complicated, and thereby also somewhat more realistic. But I'll just show you a couple of graphs that come about from us trying to say something about macroeconomic growth in the post-war era and what kind of beliefs you might have about that. So you can consider a more complicated model with sort of 3 states. This is often how we think about the world. And one state could be an expansion state, one state could be a recession state, and one state could be a depression state, or a very bad state, a financial crisis state if you want. And we're looking at sort of aggregate cash flow here, so it's not necessarily just dividends, but if you want to, you can keep thinking of this as dividends, that's fine. And you're just going to say that the growth rate of the economy, which is consumption in our case, aggregate consumption, has some mean and some volatility, and there's a shock, right? There's some news every period. Mean and the volatility. Mean and volatility is state dependent. So in the expansion states, you have high growth, low volatility. In recession, low growth, a little bit higher volatility. In a very bad state, you have very, very low growth, and the highest volatility. And you can move between these states using something we call a transition probability matrix. It's just a probability saying that if you're in state 1, what's the probability of you going to state 2 or to state 3? Now, the key part here is that all parameters in our setting is going to be unknown to the investor. The investor is going to decide on this particular model, but the investor is not going to know any parameter. And so what you have to do is to observe data and re-estimate your model every period. That is, in fact, in my view, what we do in the real world. This is what we do in academia all the time, in fact. We re-estimate our models all the time. And so this might be an important thing to think about. So we're doing exactly this. We re-estimate the model every quarter, because macro data is quarterly, from the post-World War II sample, a US sample. We use GDP growth and consumption, and you can also use some other inputs to sort of update your beliefs. And again, we use Bayes' rule to update model parameters. This is a huge kind of nasty problem, but we have lots of tools from Bayesian statistics to deal with the updating. So what do we get? So let me go back to the present value formula. So if we set discount rate to be constant, prices move around, or present values move around because you update your expectations. So what of this long run expected dividend growth, right? Forever, you discount it. So I'm just going to get exactly that. I'm going to plot shocks to the updated long run expectations. Dividends from, in a quarter till infinity, or consumption in a quarter till infinity. And I'm going to contrast that with a model where you take the model that we just saw and you estimate the model in the full sample and you set those parameters as truth. So a model where you do not update the parameters versus a model where you do update the parameters, right? And the benchmark is the one where you do not. That's with standard models. So what do we have here? This is sort of 1957. We have a 10-year burn-in after the war. This is the great the financial crisis here, Great Recession, and that's sort of where our sample ends here. The red line is the expected future long run, the shocks to valuations if you fix parameters. Now, valuations are moving around because you can go to different states. You're in expansion, you're in a recession, you're in a depression, or a very bad state. The blue line is the shocks that obtain from a model where you also have to get parameters. You also have to estimate parameters. You re-estimate the parameters every time. Why? There's tons of parameters here, so there's a bunch of stuff going in the background. I have about 20 graphs, but this sort of summarizes the main effect here. You have a lot more volatility in expectations. These are shocks to expectations. In particular, long-run expectations, because when you update the parameters, that's an update that lasts forever. That's the best you can do. And what you see is that in particular, these yellow bars here are NBR recession indicators. Those are recessions. And both models sort of pick up recessions, but what you see is that if you're uncertain about the model here, you have to update the parameters, you have way bigger moves in recessions. You say, okay, it's in recession, I'm going to put valuations down much further. Why is that? Well, it's because once the recession hits, you update the probability of a recession of being a little bit higher. If you don't observe a financial crisis and you're not sure about the probability of them happening, you'll say, oh, I'm not observing it. I think it's less and less likely. Then you observe it again, and now you think it's more likely because you didn't know the probability. And that comes from, again, the optimal updating. So every time you hit a recession, two things happen. You think the recessions are more likely. You think also potentially depressions are more likely, and you can see that sort of going on all over here. And the same thing happens in expansions, okay? And in every period, you update about means and volatilities. These expectations are about 4 times, almost, or 3 times, 3.5 times actually, more volatile when parameters are uncertain. And that's the exact excess volatility puzzle of Shiller. He says, why are prices moving around so much when expectations are so smooth? Well, if expectations are smooth, if you assume full knowledge. If you don't, they move around a lot, and we can sort of get a lot of that in a very simple setup. What about bad states? What about probability of bad states? Those are very important for asset prices because that's where we think investors don't want to hold risky assets. They want money. If you have a sort of 3-state fixed parameters, and we're going to take the probability of consumption, in this case, falling by 4% or more in a year. That's a pretty bad outcome. Real growth is a pretty bad recession. And in the fixed parameter model, where we estimate it on the full sample and set them to be fixed, that probability moves around. Every time you enter a recession, it's more likely that you might enter that depression. And so it goes up here, sort of between 0.25% probability to about 1.5% probability. But if you're uncertain, it shoots up every time you hit a bad state. And again, the reason is that once you hit that bad state, in a recession state, you're more likely to also end up in a depression. You're very uncertain about the parameters here. So you're doing a lot of updating. So there's a lot of updating of beliefs. And you get sort of these spikes here up to about 5% probability of a very bad recession versus 2 in the fixed parameters case. And here at the financial crisis, if you're wondering why there's this kind of flattening, it's because people are learning here. So at some point, they would actually know the truth. So to undo that, you would have to do something called structural breaks or some behavioral bias. Okay? So again, these are the kind of things that when you hit a bad state, price is going to fall much more. You're going to get much more. You also get option skews and these kind of things because your tail probabilities are moving a lot. That's just expectations. I didn't talk about R, discount rate, at all. I just talked about G. Okay? So expectations are moving around. They can move around a lot with a big multiplier for valuation. What about the risk premium? Well, the risk premium can be strongly affected too. And that comes very simply because if your perception of future cash flow or consumption is very volatile, then that's a world you don't like as much. So if we give people what's called Epstein-Zinn preferences, which is a relatively standard set of preferences, but they do have some particular properties where you care about sort of long-run outcomes, then you generate a lot of risk premiums because of model uncertainty. Okay? So you get a very high risk premium. And in particular, when you hit states that you don't observe much, like recession or financial crisis states, those are states where you're particularly uncertain about the parameters. Why? Well, we entered the financial crisis. We haven't been in a financial crisis for a very long time. What are the parameters here? We have very few observations. We have very little to compare with. So you enter those states, you're going to be very uncertain, and risk premiums are going to go up by quite a lot. And that's kind of what we see in the market. So I'm just going to show you that this relates to something called the equity premium puzzle, which is that's an academic puzzle. Equity premium is pretty high, but fundamentals are not volatile, so risk premium is too low in our models. Okay, and that's a statement about risk aversion and so forth. But with model risk, I can have this gamma as risk aversion. I'll just say it's reasonable. Okay, it's less than 4. The data is risk premium of 5. We can generate exactly the same thing, and it comes from this model risk channel. We can generate tons of excess volatility here. 20% return on equities versus dividend growth is about 10% in the model. And Sharpe ratios and everything is kind of like the model. I just want to show you, if you hit a bad state, kind of a depression state or a financial crisis state, in the model, prices fall by 55%. Compared to 50% in the financial crisis, or 79% in the Great Depression. It's a bit more. The conditional risk premium at the beginning of such a bad state is 40% in the model with a low relative risk aversion coefficient. That is very high, but it's based on purely on fundamentals. And the data, there are some estimates is similar. And similar with, I'll just sort of end with this, the VIX was above 80 in the financial crisis. We can get exactly the same because it hit a state where you're so uncertain about the model that you generate tons of volatility. Okay, so I'll just conclude and just say, I think that we have this extreme rational expectations assumption. It is clearly unrealistic. That doesn't mean it's bad, but it hasn't really done that well to account for the facts. And I think many puzzles are much less puzzling when you take model risk into account. And for the future, if some agents use too short windows to estimate their models, you're going to get trading opportunities. And that's the topic of the third paper that I list here that I hope you'll all read. So, all right. Thank you.